Let's talk markets. We're going to get some news, as we said, at 8:30 this morning. But our next guest has a 30-year track record investing in credit, distressed debt, and private equity. He says trillions of dollars of deals done in a zero interest rate environment will help create a tough cycle ahead. Joining us right now is Victor Khosla. He's the founder and chief investment officer of Strategic Value Partners. SVP is a global opportunistic credit investment firm with about $18 billion in assets under management. Good morning to you.
Good morning. Thank you.
It's great to have you here. We keep talking about where we are in the cycle. We just actually had a guest in the last hour, I don't know if you heard, who said, we are very late cycle. This is very late cycle. But then we had somebody actually on, I believe, yesterday, who thinks that we're on the beginning of a new bull run. So which is it?
We think we are due for a slog over the course of the next couple of years. Is there a crash coming? Don't think so. But is it a slow growth world? Is there a shallow recession in our future in the U.S.? Absolutely. So to our point of view, credit spreads are going to be wider, growth's going to be slower, and there are these accumulated problems storing up, which are going to create issues.
You like issues.
Yes.
Most people in the credit business like issues.
Yes.
And that's the polite term for them, I think.
Yeah.
But where do you see the issues coming, if you will?
Well, some of them are already here. On the face of it, you wake up this morning, you see stock markets up, you see all these green arrows.
Right.
And can I tell you, I've been doing this for 30 plus years. I've never been busier in a market which looks so serene. It looks like equities plus 16%, high yield plus 6%. And where are the issues? Manufacturing businesses. Large parts of manufacturing are already in a recession. Europe, when you think about it, already in a recession. Office property, people are hiding,
right,
waiting for maturities, right? Couple of $1 trillion in office property debt in the U.S. and Europe.
Can we talk about office property? Because
sure,
just, I would say 3 or 4 months ago, the only thing we talked about on this broadcast was office property becoming a problem come 24, and therefore becoming a problem for regional banks, becoming a problem. I mean, there was, I could show you this sort of domino story of what was supposed to happen, and I can't tell if either something meaningfully changed or if we're now all of a sudden just wearing blinders to all of this.
The things come to a head, Andrew, when you have maturities. Nobody gives up on their office property, their equity, until you have maturities. You're seeing some very large firms give up office properties already. And I think as the maturity cycle kicks in over the next 2 years, I think that's when you see this slow-moving tsunami really hit.
Okay, but you use the word tsunami, which means that something happened. It's not just one office property here, one office property there.
Yeah.
It's so many of them that then it hits other businesses.
One tree does not fall in the forest all by itself.
Okay, so, but then play out the dominoes. Do the permutations with us.
I don't want to sound too alarmist, okay? Because the world today, we're in a much better place than we were in 2008 with all the issues and fractures we had, right? But if you have a $2 trillion office mortgage market in the US and Europe, which trembles, and it trembles, it's going to make credit spreads in that part of the world just kind of spike out. It's not like the subprime tree fell in the forest and nobody else heard. It's going to affect all the other credit markets.
Okay, but let me ask you then the flip side of this is, we had somebody from Bank of America on this morning who has real insight and access to people's bank accounts, literally their bank accounts, checking, saving.
Yeah.
And the strength of those accounts, at least for me, surprised me.
Very surprising.
Especially given sort of the pessimism or skepticism that you see around where our economy is and how people feel and the like.
So, different point of view. Yeah. If you look at those manufacturing businesses I was talking about, good businesses, great market shares, 15% volume declines, 15%. GFC-like volume declines. If you look at kind of Europe, when you look at kind of the slowdown which is happening all across, it's broad-based. So we're not trying to say, hey, everything in the world is collapsing. The consumer in the US isn't. Your Bank of America data. But the other stuff is happening as we speak. So look, in the high yield market today, it looks like serene ducks gliding across the horizon, serene, right? And you look at the tumult going on underneath and how busy people like us are already, right? It's just pointing to large parts of this economy are going to struggle.
And you think at some point the stock market and spreads will catch up to that? When is that? I know you mentioned maturities, but when do you really expect this? 3 months, 6 months? I mean, what are we talking?
High yield spreads today, which is a good proxy, right? High yield spreads, you say a crisis, you're in a crisis when high yield spreads get out to 800 basis points to treasuries. It's happened 5 times in this century. Right now, we're at 400 basis points, right? No crises. The bottom part of the high yield market is in a crisis, what I'm describing, where we are kind of seeing opportunity. Do we think this is, do we think spreads go out to 500, 600 by the end of this year? Yes.
Okay.
Right? So I think our view is just, it's cautious, it's careful.